About 30 seconds here, folks. We'll get started. All right. Hi, you guys about ready to get this show on the road? Yeah? All right, then. Let's get on with it. All right, folks. I'm going to get you folks to a place where options just make sense. And I've geared this course to introduce traders like you and investors to options. And I'm sure even this old floor trader can teach the savviest of traders a thing or two. Options can be intimidating, I'm not going to lie. But what I do is I build from simple concepts to real life examples. And by the end of all of these videos, you should have a solid understanding of options. As a matter of fact, my goal is to get you folks to a place where you understand options intuitively, and I think I can do that for you quickly. So without further ado, let's get on with the video, right? All right, so we're going to be doing swing trades using options. And specifically in this particular webinar, we're going to be talking about the short call spread with swing trades. But first, I want to drill down on what is a swing trade, right? And before I get too far along, make sure you guys throw comments over there in the comment box. I will answer your questions as we go along. I'm going to make sure that you're clear concept before we move any further. So I want to make sure that we don't get behind the eight ball with this learning process. Let's make sure we're clear concept, and then we'll move forward. So throw it over there in the questions box. Also, smash that like button for me if you would. It really does help. And if you're new to this, hit the subscribe button so you guys get first access to this and notifications when we're getting ready to kick off the webinars, which are Thursdays at 4:15, or my daily market commentaries, which you can watch in the mornings. All right, so first off, what we need to do is talk about our swing trade. And what is a swing trade? A swing trade really is a trade that is going to last longer than one day. A day trade is that trade that you get in and out of within one specific day. A swing trade lasts longer than 2 days or more, we should say. But ultimately, swing trading comes from trying to find different momentum movements in the underlying, right? So what I mean by that is we need our direction, whether it's bullish, neutral, or bearish, right? So then what we're going to start to look for is patterns, all right? Or what I like to say is the trend. The overall trend is bullish, right? On this one, the overall trend is neutral. And on this one, we could say that the overall trend is bearish, right? Now, the next thing we want to do when we're looking at a swing trade is once we've identified that trend, and we can see this resistance area where the underlying has a tendency to lose the momentum to the upside or find some support on the downside. Again, find the resistance, find the support, find the resistance, find the support, all right? So that's the second step. First step, find that overall trend, bullish, neutral, or bearish. Second step is to find the support and resistance areas of this overall underlying. And then finally, the most important thing, probably, finding a swing trade is noticing that momentum shift, figuring out when the underlying is starting to make a rotation to the other direction. So in this case, we would be looking at a bullish overall trend, found the support and resistance, or supports and resistances. Now we look for the pattern within the overall trend. So we have a bullish trend. This is a bull trend, right? But we have a little bear pattern within that overall trend. Here we have a slightly bullish pattern within an overall neutral trend, right? We have a bearish trend and an overall bullish pattern within that trend. So that's what we're trying to look for, is that momentum shift when it's rallied and it's losing momentum at that resistance area and rolling over, or on the flip side, maybe a bearish pattern inside of a bear trend. We could see that too. This is a bullish pattern within a bear trend, but we could also see it rally up and take advantage of it on a bear pattern within a bear trend, okay? I don't want to get too far away from that, but we will see this show up when we are looking at the underlying, right? When we are looking at any underlying, it doesn't matter what it is, we can find, like, just blurring your eyes just a little bit is what I used to like to say, is kind of try and get rid of all the noise, and you can see where it kind of wants to top out in and around this Fibonacci, right? That would have been a good line in the sand to look at for a resistance area, and we could see support areas in and around this. Yes, it does have a tendency to every once in a while break out in little areas where it might blow through that resistance area. Know that it wants to come back down into that area because that's really where the focus of the trade has been. And usually when they get overextended to the upside or downside, they have a tendency to want to migrate back to at least the point of control, is what I usually like to say. So I like to take advantage of something like this for a neutral trend with a bearish pattern setting up within it. So ultimately, then I would look at that for a swing trade. Is anytime it came up and started looking to test this upper band, I would look for it for the resistance area, and on the bottom side, look for support areas where it breaks back in, right? Those would be opportunities for the bullish moves. So look for that in an overall neutral trend. And within that, you kind of look for those support and resistances, right? Where it's kind of doing that. Similar to that line I just kind of drew in those simple examples. Now we're starting to move on to some real life examples. Sometimes though, what happens? Sometimes what we see happen is if we have that bearish pattern, sometimes the next day it might open up like that, right? Up here above or gap a little bit higher. We can see that happen sometimes, or onto the downside. Sometimes it will break out of those little pattern areas. And when you're using, say, a stock to trade or a future to trade on these, it becomes a little bit of a dicey roll in my eyes, because it's about a 50-50 chance that you're going to be right. Well, with the options, we can get further away from where this underlying is currently trading, and that gives us the opportunity to have higher probabilities of success, which is ultimately what we want to do when we're trading options, right? We want to increase our probabilities of success. So that's what we're trying to do. Yes, it will have a tendency to sometimes break out of that little area. We were looking at the pattern in the last one where we had that candlestick at the top. That looked like it was going to be a top. Well, it never got confirmed. So one thing with swing trades, if you have a lower risk tolerance, make sure those patterns where you see a doji like this at the top of a possible like large move there, right? If you see what we call that as a hammer, then I see your question over there. Give me 1 second real quick, and I'll try and read it while I'm navigating this. So, at the top of a move, when you have something like this where you've got the green candle, a hammer, that's the one you're looking for. Well, the next day it got this. Well, that is no confirmation whatsoever. Sometimes more of a high tolerance or somebody that has a higher risk tolerance will get involved on the hammer. I would suggest, especially to newer traders, when you get a candlestick pattern set up like this, you could even have one that ended up looking as green. That's still a hammer at the top of a move. And then I would suggest for anybody, especially newer to trading options or anything else, is to seriously wait for that confirmation to show you that there is a top in that move. So a confirmation would be a candle that basically finishes out below this area or the bottom of the previous day's move. All right. So a settlement below that would be confirmation. It didn't happen in this particular example here, but it did break out up and away. I was a person that liked to get involved a little bit earlier. I don't always wait for those confirmations. When I see that momentum slowing, I usually like to jump on it, and I did with this one. Yeah, it spiked and blew off to the upside in this example, but because I was using options, I was able to stay in this game a little bit longer and let it play out. Well, you can see that the market ultimately ended up rolling back over. If I was in a short stock position, I would have been blown out of this immediately. But because using options, and I showed this as an example in my daily market commentaries throughout all of this, you can have a couple of things go wrong and still be successful with an options trade. And I show that constantly in the daily market commentaries because I'm not cherry picking, folks. I show you the winners and the losers. Most importantly, I probably talk about my losers more often than my winners. Why? Because those are the ones we have to stay mechanical with. Those are the ones that are at top of the mind, right? The winners, they come and go quickly. The ones that are, giving us problems are the ones that we need to stay mechanical with to rotate those probabilities back into our favor. Can you please leave this up? Can't catch it all right now. Appreciate the knowledge. Appreciate it, big money. We are recording this. You can check it out on our YouTube channel. And please hit that subscribe button so you get notifications for future ones. All right. Anyway, so we've gotten this idea where we try to play the swing trade. Sometimes that doesn't always work out. So we want to use these options to increase our probabilities of success because we don't always have to be right at the market when we're trading these. So ultimately, when we're looking at a swing trade, we need to identify that overall trend, the overall trend, not what's happening right now, but the overall long duration trend. Find that trend is bullish, market neutral, or bearish. Then kind of blur your eyes a little bit or use Fibonacci's. I use Fibonacci's as well. And I even have courses on how to set those charts up. But you can use that as your support and resistance. As you can even use the market profile, which is that big blue thing on the side of my charts. And then identifying the pattern. That's what is going to be ultimately what makes us pull the trigger on a directional move, all right? It's not the overall trend, it's the pattern within the trend. So why would we want to use options? I kind of mentioned this a couple of times, got a little ahead of myself, but basically it's because we have better odds of success. You're also going to be able to have less risk on the table. Whoops, that's an H, risk. Less risk, all right? And when all of this happens, you have better odds, you have less risk involved in this trade. Well, that helps you keep your powder dry, right? When you are trading short a stock, you are feeling the thumb screws immediately when it starts going against you. With options, you can even have a situation where the underlying, you were completely wrong on your directional assumption, but you made money because you set the strategy up in the right environment. And that is exactly what I'm going to be drilling down on it before going forward. Could you explain a bit of the price volume profile? Thank you. Hey, big money. I saw you said you subscribed or you're sub now. Check out the daily market commentaries. That's really where I drill down on that. I also have a couple of videos out there about it. And what he's specifically talking about is this part over here in the side. But why options? Because we are going to be able to stay in this game a little bit longer. And ultimately, we need to find different trends. Now, you can see that my trend line lined up to the bottom side earlier, but that has extended, and we are going to follow this as our support and resistances for something like, SPY, where you can see, you have a couple of opportunities. This particular opportunity right here, you might not have pulled the trigger on it for a swing trade if you were just looking to buy or short stock or the futures or even the ETFs in this case. what happens here is I could do an option strategy where I could get my strike location down here, or be able to get involved with less risk to my portfolio for a bullish move. And if it didn't work out, I had that less risk. It wasn't going to be dollar for dollar. But if I get that move, then I can take advantage of it. That's absolutely what I'm trying to do now. So taking advantage of swing trades, sometimes they don't always hit that support. They don't always hit the resistance. But with options, you know, it gives us a little bit more wiggle room is ultimately what I want you to take away from that. So here's a couple of real life examples that I'm looking at right now. And this was Kroger yesterday. We got this hammer at the top of a move, right? For me, I can see that we've got the overall swing, right? Yes, it came up and pierced above this for a little bit here. But with this type of pattern, that's something that's going to spark my interest. That's going to get me thinking that, especially if I can, let me take off the, erase this really quick just so that I can highlight this here. So here we've got a hammer right there, a hangman doji, and then a hammer right above it. Basically, those are very similar candles. That shows momentum is slowing, all right? And when you start seeing them stack up like that, you can tell, hey, this market's getting a little bit overdone. So for me, this would be something that would have sparked my interest for a swing type trade. Now, today, the market blew off to the upside, so I discounted that one. But those are something that was getting me. Yesterday, I was all over that type of trade. But again, here with EWZ, another topping pattern. We've got a lot of momentum slowing here, and then today kind of a little bit of a drop there. I'm going to call that basically a confirmation. It's not one of the best confirmations out there, folks, but I'm going to go with it for this trade because I just think that this is just been way too much of a run. We also have got a big gap right there that needs to be covered. You know, chart theory says that those gaps will be covered. It doesn't always happen right away, folks. It's not going to be in the next 2 or 3 minutes or 2 or 3 days even. It could be a week, 2 weeks. It could be, 6 months from now. But the idea is that those gaps will be covered. So make sure that when you're doing your charting and stuff, you kind of have a note for that when that area starts getting revisited, you can start taking advantage of a bit of a move to the other side as well. So anytime those gaps get covered, that's when you start looking for the momentum to start shifting. All right. So let's talk about some options real quick. What are options? We talked about the swing trade. Now we need to know a little bit about options. And when we talk about options, the call buyer has the right, but not the obligation to buy the stock. Okay. So anytime you are a buyer, you purchase, you're laying out money. Okay. So you're paying for something, right? That gives you the right to execute this contract. All right. If you're buying it, if you pay out a debit, you have the right to execute the contract. All right. If you are a seller, you are obligated. All right. So the buyer pays out something, and for that they receive this right. Okay. As a seller, you're receiving money and giving up your rights for receiving that money. All right. So the call buyer has the right, but not the obligation to buy the stock. That means if the stock is trading at 100, let's just say XYZ is trading at $100, just as an example. All right. If I'm a call buyer and I buy the 105 calls, so the calls, let's say, are 105 calls, 105 calls. That's above the market. I buy the 105 calls. In doing that, I have the right to buy the stock at 105. Now, today, do I want to buy the stock at 105 when it's trading 100 on the open markets? Probably not. I hope you wouldn't, right? You'd go out there and buy it $5 cheaper. But had you bought that 105 call when the underlying is trading 100, right? Let's say in the next 2 weeks, XYZ trades up to 200. It's the next meme stock. It's trading 200. I have the right to buy XYZ stock at 105. Am I going to do that? Well, yeah, most likely I'm going to exercise my right to buy that stock at 105. It's immensely valuable because the underlying is trading 200. All right. On the flip side, that call seller, he's losing money above 105. All right. Dollar for dollar, basically, over time, he's going to be losing on that. He has to deliver the stock at the price of 105 to the buyer. Okay. So even if it's trading 200, I have to give it to them at the price of 105. Right? So we kind of went over that. Call seller has the obligation. If the buyer says, I want to execute my right to, or I want to, I want my right to execute this contract. Take advantage of that. Now, call buyer has the right to buy. The put buyer has the right to sell. All right. I can sell it at any strike if I buy that strike, which means that if XYZ was trading 100 right here, and I bought the 10, or let's just say the 95 puts. 95 puts. Sorry, that's a terrible 95 put, but I bought the 95 puts. That gives me the right to sell that stock at that price. If it's trading 100, do I want to sell XYZ stock at 95? No. So I don't exercise my right. But if it goes down to 50 and I can sell it at 95, am I going to exercise that right? Absolutely. I would hope you would. If it's still trading at 100, I'm not going to sell it at 95, right? If the underlying is trading higher than where my put is, where I have the opportunity to sell it, I'm not going to do that. I'm just going to let it expire. It's just going to become worthless. And that put seller has the obligation, to take delivery. It means that he has to buy it at whatever price that strike is, if you set. Now, you literally can exercise your right when I could exercise my 105 calls when it's trading 100. I do have that right. But you shouldn't exercise that right. Does that make sense for everybody so far? Even if it's above, even if your strike is above, you have the right to buy it higher than where it is. You don't have to do it, though. Okay? All right. Enough about that. So, the first thing we have to do when we are trading options is understand we have to be good stewards of our capital, right? Bottom line, when you're trading, you have to be a good steward of your capital, meaning you have to understand when option prices are cheap or expensive, right? Do you want to buy something that's super expensive right now? No. But when I go over to the options, I need to look at these prices. These are the strikes I was talking about, where it gives you the right but not the buyer, the right but not the obligation to exercise the contract at that strike price, meaning a call buyer has the right to buy XYZ at 43. The put buyer has the right to sell at 43. Okay? And you have to pay for those options. Now, how do I know if these prices in the option montage are expensive or cheap? Anybody know? Well, folks, when we are trading options, what we need to know is what Vega is. Vega is implied volatility. All right, so if you see vol, that means volatility for me. I'm not ever really talking about volume. Implied volatility. I need to know where implied volatility is for this underlying, right? Why? Because implied volatility, like all the Greeks, will affect these options premiums on any given time. What Vega does, which is implied volatility or volatility in general, When volatility goes up, it increases by 1 percentage point. If volatility goes from 32 on this one to 33, 31, these premiums, this Vega coefficient will increase the premiums by that 1 percentage point. If it's 2 percentage points, it's going to be double that, right? 5 percentage points, 5 times whatever that number is. So as volatility goes up and down, the premiums are affected by that. And just like with a swing trade, we can figure out with volatility a pattern, all right? So we can see that implied volatility, I'll show you that it is more neutral, right? But there's still going to be swings in that volatility. It will get to an extreme level where there's resistance and we'll see it roll over. So each underlying kind of has its little range-bound area that we're going to be looking for. We can't just look at Vega and say 32 is high, all right? 32 might be really high for EWZ, but not so high for Tesla. Like Tesla may never get down to a 32 implied volatility. So we need to really compare apples to apples, not apples to oranges here. And in doing that, how to tell if we have high implied volatility is not from the option montage necessarily, but what we want to do is look for implied volatility. And I have a chart on all of mine for implied volatility. And we can see that there is a resistance area up here at around 56, it looks like. And then, there's a small support right around in here. It kind of broke it once, but, we could say that there's support down there as well. So it's a pick 'em on where you want your support to be. I'd probably pick for the one that's a little bit tighter. I like to discount some of those big spikes in and out of the implied volatility. If it happens twice, then it's consistent. Like you can see here, it happened there and there, and those are very close. So I want to leave that data set in here. Is that one a good one? It's a bit of a conundrum. I'm going to leave it in for my purposes. But ultimately, what we want to do is figure out where this point is in relation to the high or the high and the lows, our support and resistance areas. Because what we would expect when it gets up near those highs, that volatility is going to want to start leaking out. And when it's at those extreme lows, it's probably not going to go much further down. Like your risk for volatility is to the upside then in that case, right? So you're kind of playing it like, well, I'm extreme levels here. Yes, it could still go higher, but I see when it gets at these levels, it starts tapering off a little bit. And that's what I want to take advantage of. So I've got the bearish assumption, right? Because of the pattern within this trade. I have now decided that I have high implied volatility, right? So if I have high implied volatility for this underlying, what does that say about my prices? Well, they're very elevated, right? They're at, if this implied volatility is as high at the high levels there, what we can say is that's the highest we've seen pricing for these options in the last, 6 months, right? Therefore, they're expensive. All right. And if you really want to drill down on the details here, Thinkorswim does a really good job of giving you implied volatility percent. And what that is just telling you where it is currently now within that range that we've seen. One thing that they don't do is give you the script for 6 months. So you guys can reach out to us at protraderstrategies.com and we give our members that access to the script for just 6 months to narrow that time frame down, especially recently where volatility has been all over the place. So we can see that it is very, very near the high. So I would say just by looking at this chart that they're expensive. I can make that assumption. But if you want to really dig in on the details, basically you take the current implied volatility, that number I was talking about, minus the low implied volatility up here above us, and you take that sum and divide it by the high implied volatility minus the low volatility. All right. So some of you geniuses out there have already probably figured this out, but basically you're figuring out where this point is in relation to this high and the low. All right. And what I say, if you want to just kind of streamline your process, this is the sell zone, like if volatility is up here, and this is the buy zone. If volatility is down there, you know that they're cheap when they're below 50-50, and you know they're expensive when they are above that 50-50, all right? So what we would do is take the current, which is this number right here, 54. So we take 54 minus the low, which is like right, let's call it 28. So we take that sum and divide it by the high, which is, we're going to call it 58, minus the low, which we said was 28. All right. So we take those two sums. What do we got? 26 divided by 30, right? Which basically gives me 86.66%. So, you know, that's 80. It's in the 86th percentile of pricing. So only, you know, a very small percentage of the time that it gets a little bit higher than there, or a very small, it's only going to amount for a couple of pennies if it goes to those extremes, really. But we're looking for this to start rolling over. So I can see that once it's above that area, that's where I'm starting to look for selling. And right here at the money, if you will, those, we have some strategies for those as well. When it's kind of a pick 'em, I don't know if it's going to go up or down, and we can take advantage of options pricing in order to limit some of that guesswork. All right, when you have a solid directional assumption, then you know you want to take advantage of that. So ultimately, what we can look at by seeing this chart is that if we're looking to figure out if they're cheap or expensive, we've determined they're expensive. And if something's expensive, what do we want to do when we're trying to figure out the right option strategy? If they're expensive, you want to sell options. You want to ultimately collect a credit for your strategy. All right. Butterflies are a different beast, and we'll separate those down the road here. I'm waiting on those to be closer to the last because they don't really fit a lot of rules. They change. They go from a worm to a butterfly. All right, so we know we need to sell options, but we still have to be good stewards of our capital, right? We are at least knowing we're selling when they're expensive, but now we need to determine how to trade it. And we need to be very aware of this thief in the night that comes and steals our premiums. On the floor, we used to call Theta the Thief, because every single night that boy comes in and starts stealing your premiums. But one thing to note about Theta, when he comes in and takes your money every single night, it's not linear like this. It's not like two pennies every single night. No, what happens is, way out in time, he's not as aggressive, but the closer and closer you get, maybe he takes $1.50 or something, right? The next day he takes $1 or $2.50. Next day it's $3, right? Next day it's $4. All right. So it starts increasing the closer and closer we get to expiration. So that thief becomes a lot more aggressive when we're selling those options. Let me erase this stuff, but you can see here that inside of 35 days to expiration is a real sweet spot for selling options. Now, we don't always get that. So I like to say if you can get as close to 35 days to expiration is the best, like that's the best to do. But sometimes those options inside of 35 days to expiration will have like a 15 days to expiration or a 45 days to expiration. I would go out to that 45 days to expiration on something like this. So I'm really looking at inside of 45 days to expiration is the sell zone. All right. Outside of 70 days to expiration, this is where you would, if you were doing a debit spread, you would be getting out there. I want to, because the thief isn't very aggressive out here, right? Closer and closer we get to expiration, we need to get things on our side. And there's so many people out there trading options right now just because they're very popular And people are setting themselves up for disaster. Like if you're buying options inside of 35 days to expiration, you are fighting an uphill battle. You are literally that guy that is trying Sisyphe, right? It's a Sisyphean effort, trying to roll that rock. Sisyphes had to roll the rock up the hill. Where do you want to roll the rock, right? You want to roll the rock uphill up here, right? You want to push that rock downhill. Get that momentum in your favor, all right? So we want to sell to take advantage of that theta decay. And if you want to see like how this really bears out in the markets, you can see that on this example here, we're going to look at the days to expiration, very close to that 35 days to expiration, right? We'd have to get 1 day further out. So usually I'll opt to go a little further out. But what we notice with theta, we want to look at the theta column here, all the way down for the calls. You can look at it for the puts too. All right. This column is particular interest, right? You can see that if you were buying options out here 91 or 90 some days to 70 days, theta is only 1 penny a night, right? Then when you get to 36 days to expiration, it's already 2 cents a night. So basically going from 70 days to 36 days, we could say 35 days. During that next 35 days, theta has only increased by 1 penny, right? So it didn't help me a whole heck of a lot there. Well, if I got involved here, look what would happen the next 30 days. It over doubles. Right? 2 cents here, we lose 2 cents here, we lose 4 cents there. So it's showing me that the closer and closer I get to expiration, theta becomes more and more aggressive, right? So let's put this all together, right? We've already talked about, or at least what we've got so far, we've already discovered we've got a bearish market assumption, right? We've also got high implied volatility, which means those premiums are really expensive. That leads me towards selling options. Now, if I sell something high or sell something, I want to buy it lower, right? I want to buy it cheaper. So how can I make sure of that happening? Well, one of those things is get theta on your side. Get that thief in there picking your pocket, because I know tomorrow I wake up, I'm 2 pennies less. Every single night, and it's going to increase, right? It's going to get more and more dramatic. And if I've gotten that volatility when it's really high, if that starts coming out of the premiums, right, every percentage point, I'm going to lose the equivalent in Vega in volatility. So if I've got the high volatility and it starts rolling over, that helps me. Theta starts working in my favor. That helps me. The underlying goes higher, that hurts me, right? My directional assumption's bearish. But the beauty in trading options is I can get a little bit further away from where the underlying's give me a little more wiggle room. If I get involved in this as a short, then every time it upticks, I'm feeling the pain. With options, volatility started coming out. I had that theta on my side, this upticks. I could probably be making money with all of those other levers and pulleys working in my favor, all right? So I don't have to be the smartest guy on the planet on picking directional assumptions. I can use options when I come up with this assumption to increase my success rate. So we want to take advantage of theta getting closer to expiration when we sell options. When we notice those options are expensive, we immediately know we need to be right around that 35 days to expiration to take advantage of that theta decay. And please, if you guys have any questions so far, throw it over there in the side comment box. I'm going to make sure you're clear concept before we're moving over. Since you aren't asking a lot of questions, I'm assuming I'm doing a fantastic job for you guys so far. And if so, click that like button. All right. So, short call spreads. We've determined we're looking at a short call spread. Why? Well, because I want to limit some of my risk. if I was, not worried about that risk, then I would have probably just gone with a short call. And I actually did a short call spread in my IRA and the short call in my trading account for this swing trade. And in my IRA, I can't do a short call. I can't do a naked short call. It's illegal in an IRA. So I'm going to do the short call spread there. All right. I have better probabilities of success with my naked short, though, just know, than my short call spread. All right. So the first thing, before we start getting involved in this, we need to talk about delta, because delta, we already talked about implied volatility, right? Vega. We talked about theta, that thief in the night. And now we need to talk about delta. And usually when we're talking about the definition for delta, it's the rate of change in option premium, meaning for every dollar this underlying moves, our premiums are going to adjust by the corresponding delta. But on the floor, more importantly, we used to just talk about it as data, all right? Because delta tells us all kinds of different data points. But one of them really is your probabilities. Probability, sorry, got my L in the wrong place. Anyway, your probabilities, all right? So like a 45 delta is just 45% chance of being in the money, all right? 45 delta, every time this dollar or underlying moves up by $1, my delta would affect my premiums by that amount. But more importantly, delta tells us probabilities of being in the money, all right, by 1 penny at expiration. So probabilities, and also if we go two times the delta, folks, that equals your probability of touch. This is what we used to say, a probability of being kissed on the floor. Being that strike, remember our old example, XYZ is trading, 100, right? Was trading $100 and I had those 105 calls. Well, those are probably like about a 45 delta, let's say. That means during this, I have a 45% chance of being in the money by 1 penny at expiration, all right? That means the underlying is trading 105.01, $105.01 at the expiration. But 2 times the delta is the probability of touch, meaning that is a 90% chance of 105 trading. Okay, there's a 95% chance that the 105 strike will trade. All right, so 2 times the probability, or 2 times the delta is the probability of touch. Very important when you're trying to keep your powder dry, folks. When you know your probabilities of being in the money, you know your probabilities of success, you know your probabilities of being tested are twice that of the probabilities of being in money. That helps you stay calm. And when you're a calm trader, you're staying mechanical, you are going to be much better at trading options. All right. So moving forward, let's get to strikes already, right, Wolfman? Well, we got to go back to another correlation really quick. Standard deviation curves, right? We're talking about this from, when you were in grade school, you'd grade on a bell curve, meaning, basically anybody that had an A was here, anybody that had a B was here, anybody that had a C was here, anybody that had a D was here, and anybody who had an F was there, okay? Well, it's kind of the same here. But what we're looking at is these are standard deviations, right? And options are correlated to standard deviations because it's probabilities, right? I just told you that the probability is equivalent to the delta of being in the money. So these are all your probabilities of your standard deviation. So in that, like a negative, we could say this is the put side and the call side. And if you are looking at the call side, right? This right here would be basically, this would be an 86% chance-ish, 85%, 84% chance, sorry, 84% chance or an 84 delta right? An in the money call below where the underlying is trading has an 84 delta, right? This call right here would have basically a 30, sorry, that's the half standard deviation. This was going to be about a 16 delta, all right? About a 34 delta, okay? Because you're adding here, you're adding all of these up. Here, you're adding all of these up all the way out, okay? So the probability of this happening. So when we're looking at this and you add up like a 1 standard deviation move on the puts, you could say that a 1 standard deviation move for the put would be the 16 delta. The call is the 84. You add both of those together, you get 100. And that's the way it should be. All right. So the 16 delta put is basically the 84 delta call. Because there's a 100% probability of something happening when you add all the probabilities together. So the reason why I say this is in this particular strategy, we could set it up where we want to get at around that 36 delta. That's right around that half standard deviation move to the upside, okay? And we're going to try to build this to where we risk 1 to make 2. All right. So in this case, if it's a dollar wide, if we have a dollar wide spread, then we would want to have a 33-cent credit, right? Because I'm risking 33 cents, or I've got, I just said that backwards. We're trying to make one, risk 2 to make 1. Risk 2 to make 1. Sorry, folks. I don't know why I said that backwards. Got my head backwards. So we're trying to make this 33 cents, and we're risking 66 cents. Now, you guys might be looking at me going, wait a second, folks, that's not a very good risk reward. Well, you have a huge advantage in the fact that your probabilities are in our favor. So when you have much better probabilities, meaning much less chance of this going wrong, well, you're going to receive less for taking that risk, okay? So in this case, I have a huge probability of success here. I have about a 66% chance of success. So therefore, I'm not going to be able to get as much out of that trade. So I'm risking 2 to make 1. And I'm starting with this 36 delta out of the money call. And then I'm going to use this. The one that I buy defines the risk, but it also is going to set it up where the width of the spread, my credit, is equivalent to a third the width of the spread is ultimately what we want. A third the width of the spread. And then once this once my long call is breached, that's probably where I'm just going to let it ride out. I have a defined risk strategy. I don't have to worry about it once the upper band of my strategy has been breached. The beauty in this is if it happens, I'm playing the probabilities out. Probability of touch is 2 times better than the probability of being in the money. I would be looking for it to roll back over. Since it's defined risk, I'm going to let this trade ride out. But I want to start as close to that 36 delta as I can when I'm entering this trade. So if we go over to the example here of what I was looking at today for this short call spread, you can see that I did not have an exact 36 delta short call. See, I'm starting out with this 42 call here. That's the one I shorted. That was just slightly deeper than that 34 delta. All right. I couldn't get it really to work with those 42 and a halves. But you can see what so I had to slide a little bit closer, which is you're starting out as that 34 delta, but you're most likely going to have to go a little bit, just slightly a little bit tighter in order to get that credit where we're trying to receive a third the width of the spread. And again, here you can see 33-cent credit, $1 wide. I collected 33% the width of the spread. Does that make sense? Right? So I'm selling one 42 call because I am bearish. My risk is when this underlying trades above 43. That's when I've lost the full width of the spread. I have no more risk above 43 if that happens. All right. So defined risk strategy. If the underlying sells off, then and volatility comes out of this strategy, then I'm going to see this become a winner almost immediately. And in this case, this is one of those situations where I'm short at 42. That's where my risk really lies. Short at 42, right? That's where I would have to sell this underlying. If it stays below there, though, this entire time, I'm going to get to keep that entire collection of credit, because an out-of-the-money short call, that means it's above where the underlying is trading. Is anybody going to, exercise their right to buy it higher than where it is? No. So it's going to expire worthless. And that's what I'm looking for in this trade. This underlying could be trading, I'm short at 42. At the last day, it could be trading $41.99. And as soon as that bell rings, my options are out of the money. The full collection of credit is mine. Now, you could see you getting that full collection of credit before the end of the day. Now, I like to say cover these for about 5 cents, especially on a stock that's below $50. Because a stock that's below $50, folks, your rule of thumb is a stock below $50 is going to be about $3 wide, $2.50 to $3 wide. Stock from 50 to 100 is going to be about $3 to $5 wide. $100 stock to $200 stock, $10 to probably $15, all right? And it's going to increase as you go higher. It's usually right around, I'd like to say about, 5%, the width of the spread of the under. 5% is what you would find for the width of the spread when you're getting above $100 stocks. Below $50, go for the $2.50 or $1. In this case, I had to go with the $1. All right. So anything below $42 at expiration, I get to collect that entire credit. If it goes above to the upside, I'm going to let it get out. I'm going to let that expire, take the full loss on the trade, and be done. But if it goes down, I can get out for a nickel. I'm going to exit there. So here's our risk parameters on this. You can see the reward is if the underlying goes down, the price down here goes down. So if I'm directionally right, that's a winner. Now you can see that I have limited risk if the underlying goes above $43.35. So $43.35. So break even is, my risk to the upside is just slightly shy of 43. It's 42.65 is my break even. And reward, anything trading below 42 at expiration is going to be, I get to keep the full credit. If it lands right in between there, it's going to be the difference. My break even to the upside, I collected a credit. So my break even is $42.35. It's the credit plus the short call. That's my break even. All right. When do I get out? Well, I kind of talked about that. I'm going to look to get out on a stock if it's less than 50% or less greater than $50 to $100. Let's just say $100. We're looking at $5 wide, right? And then I'm looking to get out of these on the bigger ones. I'm going to be looking to get out of 50% of max profit on any of the bigger ones. If it's less than $50, because you're only going to be collecting, especially like 33 cents, I would be looking to write it out. Or collect, or write it out, or get out for a nickel. All right. That way you collected about 28 cents on that. 50% of 30 cents after your commissions is really not going to be worth the risk reward. I'd write it out a little bit longer. But basically, greater than $50 is kind of where I was going with this. You're going to be looking to get out at around 50% of max profit. So if I collected $1, I'm going to be looking to get out when it's trading around 50 cents. I can buy it back for 50 cents. Any other questions going on before I move on? So ultimately, just a little bit of review here. Swing trades. Identify the trend. Identify the support and resistances. The pattern within the trend is ultimately what is going to prompt us to a directional assumption. And then when we're using options, we have to figure out if they're expensive or cheap, right? We do that by looking at implied volatility. If we determine they're expensive, we want to collect a credit, all right? If we collect a credit, we then want theta on our side, right? We want that thief in the night to come and steal our premiums. So we've got that going. So we want to be inside of right around 35 days to expiration. That's our wheelhouse for selling options when they are expensive. And then finally, with this strategy, if we have a lower risk tolerance, or we have an IRA where we aren't allowed to do a naked short call, we are newer to trading options, then we're looking at this short call spread for high implied volatility, bearish directional assumption. All right. All of those things, we go to the short call spread. I need to collect 33% the width of the spread. That means $1 wide spread, I'm collecting 33 cents, right? $5 wide, I'm collecting about $1.60 something. All right. Or $1, actually it's $1.25, right? No, third the width. Yeah, $1.60 something. So that's what we're looking to do. You can easily just multiply it by 0.33. Okay. Okay. That communication's not for me. All right, good enough. Well, without any further questions, then here's your guys' offer. We're going to be doing this Wolfman's Options Lab. You guys can take advantage of this. You get the entire catalog of my options courses. Basically, the first 100 members are going to be chartered members, so you guys will be able to take advantage of all of it. You'll also get instant access to me. If you guys send me an email, I am going to reply to you immediately, if not sooner. If I can't do it in an email, I'll give you a buzz. I'll be like, hey, let's jump on a phone call or a Skype meeting, and we'll walk through this to make sure that you guys are clear of concept. So that is really important. You guys get a mentor. That's something that I cherished when I was trading. You can make a lot of bad, silly mistakes, like buying options when they're extremely expensive, right? So, you can take advantage of that and all kinds of other VIP invitations for that. For $97 a month, you guys, just to have a mentor, it's worth that. All right. Again, here is your link for the Options Lab. Take advantage of that. And finally, here is our disclaimer. Please take a moment to pause and go over that, as we're an educational company, folks. I'm not trying to get you guys to do these trades. What I'm trying to do is show you how options can increase your probabilities of success and ultimately turn the tables around on your probabilities. All right, so take advantage of this. Click on that link over there in the chat window that we've got going. You can get a straight shot to that. All right, that's all I got for you guys. Other than please subscribe before you go. Make sure you get notifications for the next ones and the daily market commentaries. Also, like I said, subscribe, comment over there on the side. I'll come back and check these comments out. Make sure you're clear of concept. And finally, smash that or take that. Bye for now, and take it easy.